Hey, welcome back to Compounding Quietly. QLD looks like an easy decision when markets are climbing, but most investors who hold it have never really pressure tested what they are agreeing to. That gap between what the label suggests and what the instrument actually does is where most of the confusion lives. Let's get into it. There is a picture that investors carry when they first encounter QLD. The Nasdaq goes up. QLD goes up twice as much. The logic is clean. And in the right market conditions, a steady upward trending year, that story holds up beautifully. Investors who caught strong Nasdaq runs with QLD in their portfolio saw returns that felt almost too good, and that experience has a way of staying with you. It becomes the reference point you return to every time. The Nasdaq picks up momentum again, but that is only one chapter of this story. The investors who held QLD through a difficult year, like 2022, encountered something different. Not just losses, but losses that arrived faster than expected, cut deeper than a standard index fund would have, and recovered on a different timeline entirely. In some cases, the underlying index had already bounced back, while QLD was still working through the mathematics of a leveraged drawdown. For investors who did not understand why that was happening, it was a genuinely disorienting experience. They were right about the direction of the market in the longer term, but the instrument was not built to reward that kind of patience, the way a standard fund would. That gap between expectation and experience is exactly why QLD keeps coming up in investor conversations. It is not because the fund is obscure, it is because it sits at an uncomfortable intersection, appealing to the same instincts as long-term investing, but operating on fundamentally different logic. And most people who are drawn to it have not fully worked through that distinction yet. The question that gets asked most often sounds like this: is now a good time to add QLD? Or, the market has been strong, should I be holding more of this? But there is a prior question that has to come first. What kind of instrument is this? How does it actually behave? And under what specific conditions does it work the way you are imagining it will? Until you can answer those questions, the timing question is the wrong place to start. Let me walk through the structure of QLD because the structure is everything. QLD is a 2x leveraged ETF that tracks the Nasdaq 100. Its stated objective is to deliver twice the daily performance of that index, every single trading day. That means if the Nasdaq 100 returns 1.5% in a session, QLD targets a 3% gain. If the index falls 2%, QLD targets a 4% loss. On any given day, the math is straightforward. But the moment you extend that across multiple days, the behavior starts to diverge from what investors typically expect. Here is the concept that matters most, and the one that causes the most confusion. It is called volatility decay, and it is also referred to as beta slippage. It is not a flaw in the fund. It is a mathematical consequence of applying daily leverage to a compounding return stream, and it becomes more significant the longer you hold, and the choppier the market environment is during that time. Let me give you a concrete way to see it. Suppose the Nasdaq 100 drops 5% on Monday. On Tuesday, it recovers 5%. After 2 days, the index is sitting at a loss of just 0.25%, nearly flat. Now apply 2x leverage. On Monday, QLD drops 10%. On Tuesday, Queensland gains 10%, but that 10% is calculated on a lower base. After 2 days, Questrund is down approximately 1%, 4 times the loss of the underlying index, for a round trip that looks almost flat. Now, extend that 2-day scenario across weeks of choppy sideways movement. Every round trip that the index makes every day, it drops and recovers, leaves Queensland slightly further behind on a relative basis. The decay builds. And this is why investors sometimes find Queensland still underwater, long after the index has bounced back to its prior level. They understood the direction of the market correctly, but they did not account for what the path of that recovery would cost them inside a daily leveraged structure. Coming back to the original question, when is QLD the right instrument to hold? The answer is a specific one. QLD performs well when the Nasdaq 100 moves in a sustained directional uptrend, with relatively low volatility along the way, steady progress, minimal whipsawing, a market environment where the index climbs, without giving much ground back in between. That is when the 2x structure compounds in your favor rather than against you. That is not the condition of most market environments. across any given 12-month period. It describes specific windows, and identifying those windows is part of what the QLD investor has to do. This distinction also matters when you think about how Queenland sits alongside other positions you might hold. A broad market index ETF gives you exposure to long-term compounding. It earns its return by being present through the full range of market conditions, the good years and the difficult ones alike. QLD asks something different. It asks you to identify a window, to have an entry that makes sense, a holding environment that you are watching for, and an exit framework that you are willing to act on. Those two instruments are not versions of the same bet. They are built for completely different kinds of investors, making completely different kinds of commitments. If you are holding QLD without that framework, if you are holding it because you believe in the long-term direction of technology, that is a real conviction. But the instrument does not reward that conviction the way a standard index fund would. It rewards precision, and without precision, conviction alone will not protect you in the environments where QLD performs its worst. Here is what I want you to carry forward from this. QLD is a legitimate instrument. It has a real role in certain portfolios for investors with a clear and deliberate framework, but it is not a forgiving one. It does not accommodate vague plans or loose exits. It does not reward you for being directionally correct without being structurally prepared. The investors who use QLD well tend to share one thing in common. It is not that they are the most aggressive or the most bullish on tech. It is that they have answered the structural questions before they entered. They know what environment they are looking for. They know the conditions that would prompt them to reduce or exit, and they have defined those things in advance, not in reaction to what the market is doing in the moment. That is not a small thing. In a market that constantly offers new signals and new reasons to adjust, having a clear framework before you enter is one of the most underrated advantages an investor can carry. If today gave you a clearer picture of what QLD actually is and how it behaves under the surface, that is the goal. Not to tell you to hold it or to avoid it, but to make sure that whatever you decide, you are deciding based on what the instrument actually does, not the story you told yourself when you first discovered it. That kind of clarity is the starting point for every good investment decision. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.